12 chairs. I've used up all of my knees. I'll tell you about cycling in India another time. Those of you who come from there will go, what the hell is she doing there? Right? But anyway, I guess I should ask, can you hear me and can you see me? And is this okay? Yeah, cool. Okay. So I was talking about the inequities of conventional venture equity, and you were talking about the inequities of, if you will, the silent burden that women carry as they form their companies. And there are, I guess, not really hacks. I used to think it was a hack to be able to do all of that. I raised 3 children under my desk, and I was the co-founder of Moz. I built it with my eldest son, which is still an unusual business relationship, mother and son. You know, fathers and sons and uncles and this and that and cousins and whatever. Mother and son is still an unusual business relationship. It was an honor and a privilege to be an executor, the one who executes on the ideas of a wizard, a brilliant wizard. And my best tip in business, by the way, is you raise your CEO first, you know the men you've got. So that's cool. But it was a successful venture. That's great. It was not easy. It was ugly for a lot of the way through it. And, you know, we talk about the hockey stick. You know, they didn't tell you that's the short end of the hockey stick. The hockey stick goes out that way. And this is the little end at the end, right? And even this isn't straight. It goes down and it gets into all kinds of mess, and then it finally comes back. I was born and blessed with an extraordinary amount of energy. The force of nature are the kind words that people use to describe me. Most people just get exhausted. I got 69 years of that. I didn't get the 70th. And so in my 70th year, I now understand what it is to be mortal for the first time. Most people don't have the kind of energy that I was able to draw on to work all night, take 2 hours sleep, wake up in the morning, take the kids to school, do the stuff, take the baby with me, whatever it was, and so on and so forth, and then do it again, again. So I had a very traditional marriage. My husband worked for the Boeing company. The concept of fail fast, fail often, sing kumbaya, not so much. They take human bodies 300 to 600 at a time, they throw them in an aluminum tube and shoot them into the sky. There's a very famous talk from the Boeing, the head of Boeing Commercial, president of Boeing Commercial, in their 75th anniversary, where probably 50,000 people, if not more, in the great big parking lots of the Boeing field in Renton, where they were building these planes. And he said at that time, in the early 80s, no, I'm sorry, this was 1990, he said, if we aspire to the same level of perfection of performance as Federal Express, which in those days was running advertisements that said 99.97% on-time delivery and so on, we will only kill 1 million people per year to go make airplanes. Now, they've lost their luster, but they used to be an extraordinary company, and nobody died. You could rip the side off a 747, watch yourself land in Hawaii, it's been done. You put a bullet hole through any other plane, and you kiss yourself goodbye. Right? It was an extraordinary company. But it didn't fail fast, and it didn't fail often. It had a very rigorous structure, so he went to work every day, and I had the easy thing, which enabled me to do what I wanted to do. Somebody else brought the money home. Now, I gotta say though, when he retired, I got a wife. He did the laundry, he did the groceries, right? It switched, it changed. So once the nature of the relationship is more about its nature than what it looks like on the outside. Okay? He did what he had to do to make sure I could do what I needed to do. It was an extraordinary gift. Now, all of that aside, the most important decision a woman in business will ever make is the selection of her mate. That doesn't come from me, that comes from Sheryl Sandberg. I agree with her. The decision about who you will live with, spouse or otherwise, is the most important decision. Not so much for a guy, but for a woman. That's number one. Will you have the support you've required to make this thing happen? 2, an extraordinary amount of energy is required. It doesn't make it fair. The things are changing around who does work and who doesn't in a household. We recognize, however, that there is a massive burden on women, and it continues to this day. Again, you don't have to like the realities, but you have to deal with it. Now, that would be the answer to your question. There are no easy outs. And it will take an extraordinary amount out of you. If you have a supportive spouse, it will make a huge difference. Do not build your companies in spite of who you hang out with, but rather than the support of who you hang out with. And if somebody understands that you carry an extra burden, you can take some of it off, well, it's not a good answer. It's the best one we have so far in 2025. So my name is Jillian Music, and I'm the Managing Director of Mastersfund, where we invest in companies with at least one woman in a position of strategic and operational control. This means the CEO or the COO position. We do so not because it's philanthropic behavior, although I will readily admit I came to the table with a crashing fist on that table saying not on my watch when I found out what the numbers were. And I did not know those numbers until after I exited my own startup. So, with all of that in mind, we did a great deal of research, my colleague Ann Kennedy and I, and we found out that companies that have women at the helm have been returning for more than 30 years now an average of 35% higher ROI to their investors. Wow. You know, I know that correlation is not causation, and past performance is no promise of the future. But I'd say after 35 years, or 30 years, we take a look. What do you say? Yeah. So we decided we'd take a look. We looked at other points of interest. Founding teams that are 2 perform better than founding teams that are 1. That makes sense. A solo entrepreneur is literally challenged by enough hours in the day. Find yourself a mate for your business. Not necessarily the same mate that you're living with, but it could be. You never know. Okay, that's number 1. And 3 actually slows the decisioning process. Isn't that interesting? So 2 is the killer one. They succeed more quickly and more regularly and at higher valuations. Same with the teams that have a woman at the helm. They succeed more quickly at higher valuations and more regularly than those that don't. Wow. Okay, and this is all conventional venture equity, by the way. So the reason we invest as we do, our thesis looks like it does, and our investment criteria does, are about these numbers. So you get an idea of what we're looking at as venture equity investors, but then I will tell you also how we invest, which is a bit novel as well. Okay. Women are getting 2% of conventional venture equity. Well, as an investor, I like finding my unicorns in other crowded fields. Nobody's beating me out for the best deals. Nobody's even looking at it. I get very good deal flow. This is great. Number 2, when she raises the capital, the woman is offered worldwide an average of 16% of the pre-money valuation awarded to a guy who pitches exactly the same deck. Oh, as an investor, you just got told you can get an 84% discount on your initial invested capital based on the human body standing in front of you. Whoa, that's what women keep talking about. A woman will raise, by the way, it was the Swedes that did that work for us at Swedish University. They gave a deck to a guy and a gal, and they did it again and again and again. And they sent them all over the world to pitch and so on, and never crossing over, so the VCs didn't get the idea. And that's what the numbers do. Then, a woman will raise an average of 44% of the capital that a guy will raise in the same industry to exit at the same number. You just got told 56% less dilution every time an entrepreneur raises a buck. You get diluted as an investor. Like that one too. A woman will exit her company 1 to 2 years earlier than a guy in the same industry. Depends on the industry and so on. It's good. Time's a risk factor and a cost factor. Investors like that too. And then when she exits, the woman is returning an average of 35% higher ROI to investors. Back in 2016, First Round Capital reported from their 2005 to 2015 fund, actually the 2005 fund, had the women returning an average of 63% higher ROI. So again, averages, not mean, past performance, no promise of the future. Once again, I'd say we take a look. Now, as an investor who was managing a fund, not just my own capital, but managing a fund, I had to answer a few questions when we put the fund together, right? We're going to invest with women at the helm, and the women are getting 2% of venture capital at the Series A. We're going to invest in the Series C, which comes before the Series A. How am I going to return an ROI, a return on investment, to my LPs, limited partners, that's the name for the people who invest in a fund, if the women aren't getting through the Series A. I can't fix that in 5 years. I haven't fixed that since 1946. How am I going to return the ROI the women aren't getting through the Series A? So I had to come up with an investment model, an instrument that would answer that question. How do investors get their money in, and how do we give them an offering? Besides which, many investors were saying, you know, I'm getting real tired of this VC game. I put my money in, I wait 10 years, now 12 years, now 14 years. The companies are paying the bills, they're doing fine, but where the hell is my exit? I'm getting very tired of that. And at my age, I have to wait 15 years to get an exit. Forgive me, but I'm too old to care. So there had to be a sooner, an earlier way to get the money in and out. We call that liquidity. Creating liquidity in an illiquid market. And in general, venture capital is an illiquid market. You lock up your capital for a long time. So we created something called a structured exit. A redeemable convertible note. It looks like a convertible note or a safe, but in both of those instruments, usually it's line 7 or 9, it says this is not redeemable. It's going to convert to equity at some future date. Right? And with that, we now have the risk tolerance or the risk profile of venture equity. Right? It's the search for the unicorn. There's only 2 ways to get your money out of conventional equity. So this is an insight into how the VCs are thinking. Okay? 2 ways. You're going to get it out of your company when it sells or it has an IPO. As soon as you have taken even $1 of conventional venture equity from a venture fund, and angels you can deal with in other ways, but from a venture fund, you've agreed to 2 very important things. The first one is that you will sell your company as quickly, expeditiously, and at as high a valuation as possible. Very rare instances you get to go. Second thing you've agreed to, serve the pleasure of your board, and you can be replaced. If how you wish to deal with your employees, your customers, your vendors, or your trajectory to that exit and its height should differ from that of your investor, you will be replaced. More than 80% of all CEOs of venture-backed, successfully exited companies, that's 2 modifications. It's got to be a venture-backed company, and it had a successful exit. More than 80% had the CEO replaced. They could not take it to the finish line. Sure you want to make that deal with the devil? It's got to be worth it. The average entrepreneur owns between 8 and 12% of their own company, depending on the industry, at the end of a venture-backed successful exit. You made somebody very wealthy. Was it worth it? It's worth it if you have a $1 billion exit. It sure shouldn't is. And sometimes, again, averages aren't mean, so sometimes you own a lot more, and you'll read about those. But they are rare. This search for the absurdly tiny kernel of companies that will become unicorns, let's get a feel for that. Venture equity or venture capital was invented in 1946 as we understand it today. Certainly it existed for centuries before, but as we understand it today, it was invented by this guy, Georges Goya. He also, by the way, created INSEAD, for those of you who might know this college of business in Paris, a world-famous university. And he was a military strategist for the United States, actually, during the Second World War. So a real underachiever, this guy, right? So now, he's going to form ARD, and he wrote white papers about it. He said that he thought 2% of his investments would pan out, and the rest would be rubbish. Today, nearly 4%, 3.89 something percent, have a happy exit defined as 3x or better to the investors. So 3x means you put in $1 million, you're going to get back $3 million, and the fund got something, and then there's the cost of the fund. Funds operate on something called 2 and 20. 2% of assets under management, of the stuff that's invested by those LPs, is used every single year to operate the fund. By the time you're done after 10 years, because they're set up as 10-year funds, 20%. The expenses of the fund, like the accounting and the attorneys and maybe the real estate or whatever, right? That's in addition. The fund will pay usually a maximum, they usually cap it at 3%. Some people just say, no, just charge 5% flat, we're gonna operate the whole thing. Sometimes they say, we'll cap it at 3%, sometimes they don't cap it, and it could cost more. Okay? But let's say it's capped. Now we have a total of 5%, right? 2% to the general partner, it's kind of their salaries, if you will. The second one is around the other operational expenses. So 5% times 10 years. You don't get to invest a whole lot as a general manager, do you? As the managing director. You invest about 50%, and you still have to return 3x or better to the investors. That's the goal. As a result, it's no surprise that venture equity investors, these venture capitalists, are looking to all of you to prove to them that you can return at least 10x to the fund, because that's what it costs to get the 3x back to the investors. We're not even talking about unicorns yet. It was February of 2022 when the world saw 1,000 unicorns since 1946, and all of those trillions of dollars of assets under management invested. They finally got to that. This is the search for the absurdly tiny kernel of companies that could become that unicorn. Most of you, none of you actually raised your hand and said, I'm building a multi-billion corporation. None of you said, I'm building a unicorn. But you're being taught to say so. And they kind of like me to sit up here and give you a chart that says, 30-point plank or whatever it is, 10 pages, these bullets. It's nonsense. Bullets kill kids. It's nonsense. You're being taught to lie. I'm going to make you $1 billion in 5 years, and this is how I'm going to do it, or maybe it's 5 minutes, and there's not a shred of detail. But that's not the case. Okay? So we came up with this investment instrument so that investors could get their money in, and then with a structured exit, they could get their money back out. We can explain all about that later. It's just a form of venture equity now. Right? And there are other forms. Finally, venture capital is beginning to evolve. Most of the VCs you visit, it's just going to be, I'm going to hand you cash, you're going to hand me stuff, we're done. Okay? Most of them. But a few are beginning to change and evolve. There are so many ways to capitalize the growth of an early stage privately held corporation. Think more broadly. You're going to need a different kind of capital to get you over the first body of water, and then over the fields that are beyond that, and then up into the mountains and over to the promised land. It's different kinds of capital. The later you can take conventional venture equity from a venture fund, the better. Because you're going to hand out the most amount of stock for the least amount of money at the earliest stages, because that's when it's worth the least. Right? This is intuitive. It doesn't take rocket science to figure that one out. Now, dividend models, royalty agreements, revenue share models, venture debt, mortgaging your residence. There are so many ways to capitalize the growth of your company. You have to decide with whatever significant other you may have, if you do, what you will risk and what you won't. We will not use the children's education fund, or we will. We will not mortgage the house, or we will. You will make that decision. Okay? But think it through carefully. There are many ways to capitalize the growth of the early stage company. If you're not building a unicorn, but rather, if you will, a privately held mid-cap corporation, these things can be cash cows. Last time I checked, Berkshire Hathaway was a privately held corporation. That ain't nothing but small, right? Okay, nobody got it. Doesn't work. All right, privately held corporations can be cash cows. And we are hearing over at Mastersfund, and other my colleagues as well, whom I have many, many around the world, are also hearing from both men and women that they're not building scalable corporations that will be unicorns, but rather they're building mid-cap privately held corporations. I said, what if I'm being, honest? I'm being told to lie about it, or I won't get the capital I need. They said, but I'm just building this. I don't have to run it forever. I can put in a CEO and a COO. I can sit on the board of directors. It's a cash cow. Why would I sell it? With the money it throws off, I'm going to go build that one, and then this one, and that one. By the time they're done, they can sit on the shores of Bora Bora and be on the board of directors of 4 or 5 companies that they have created over a lifetime. And they don't have to sell any of them. They needed different ways to raise capital and to pay back their investors in a reasonable period of time. Dividend models are a brilliant way to do that. My own son, we are both exited out of our company now. He has a second one, and he raised capital with the dividend model. He was not enchanted with the venture equity model, not as I. So even though I am a venture capitalist, and this is put on by venture capitalists, right? Look more broadly at how to capitalize this, how to negotiate it, and specifically how to make it mutually beneficial. Here's the thing, VCs are not being assholes. Somebody has handed them a box of money and said, how big will it be and how quickly will I get it back? And so he's going to do the same for you. He'll hand you a box of money and say, how quickly will I get it back? How large will it be? It's got to. It's the fiduciary responsibility of the managing director to return an ROI to the LPs of the fund. You've got to do it. So know the game that you're playing. Make sure you want to do it. Don't do it at all. Dividend models means you take a number of angel investors and you begin. Not a bad way. You say, all right, put down some cash. We're going to use that cash for approximately 3 years, maybe 5 years, whatever it is. At that point, the financial projections will, suggest that the company will be earning this much. We will then declare a dividend because now it earns more than its expenses. In other words, it is profitable. It has reached that balance of financial stability. And at that point, the founders or the owners of the company will declare a dividend. And being a stockholder in their own company, they participate in that dividend. Much better way for founders to take their money out. If you pay yourself a salary, it's the highest tax in the United States, most countries, right? Why would you do that? Take a much smaller salary, take it out as dividends. You will pay a lower tax on it. It'll be worth more to you. It could be more capital efficient for the company. Now, the investors start getting their money back out. And then you can write into the agreement that at such time as you've received 3x, 4x, 5x, whatever it is, you put down 100,000 when I paid you 500,000, the company has the right to buy the stock for a penny or a buck or maybe at market price. You decide what that number will be. Make it mutually beneficial to your investor, but give them an off-ramp and you get a lot more people to get on the on-ramp. But you don't hear about that in general because it's not part of the bookwork. But it is part of the evolution of venture capital. So stay at the edge of that and look at the different ways people are doing these things. Royalty agreement, for example, would be very good if you had a line of business that was perhaps software, and this one particularly hit, I don't know, a specific market, or it had a specific line of business, and it was a little different than the other software you were building. Fine. Right? It just means from that line of business, whenever that stuff sells, that's what your investors will get a piece of, because they are helping you to build whatever that line of business is. It's just segmenting. There's so many ways to do this, and none of them are about friends or family or seed rounds or pre-seed rounds. By the time you get to a Series A, and you're going to approach a venture equity investor, a venture fund, past angels now, they're going to want a significant amount of accomplishment before you get there. They're going to want to see that, one, your company can scale. It means you don't just have something that you're selling, a product, a piece of software, whatever, and you don't just have some companies buying. You have something that can scale. That means with every successive sale that you make, it is a lower cost to sell it, and a lower cost to serve it, and a lower cost to keep that customer. If it still costs you the same amount to acquire the customer, serve the customer, keep the customer, well then you have a lifestyle business. And again, they can be cash cows, but it's not a scalable business. Venture equity funds are designed to invest in venture scalable businesses. So, way back in 1946, when George Doriot wrote his white paper, he said he was going to invest in companies that were being built by the GIs coming home after the Second World War, which, if you recall, ended in 1945. Okay, so they were coming home in 1946. And they had some pretty good ideas about what he called the innovations that would power the human existence on planet Earth for the next century. Massive risk, massive reward. This guy was a finance professor. He took the concept of a fund, like a hedge fund or any other kind of equities investment fund for the public markets and so on, and he stretched it to the mathematical limit, like calculus, right? We are always balancing risk and reward. He stretched it to the very end. 98% would be rubbish. 2% would pan out. Of course, you had to find the one to make that happen. And it worked out. The United States wanted to get involved right away. They wanted those innovations that would power the human existence on planet Earth for the next century to happen in the United States, because the country that owns the innovations, if you will, the technology of today and the near tomorrow, owns the planet. And so they did. Pax Americana from 1950 on. We got to the moon. We put computers into big buildings, and then onto our desktops, and then laptops, and then cell phones. We hold in the palm of our hands more technology than took humans to the moon every single day. Okay. And then in 1994, there was a crack in the universe. It was the arrival of the World Wide Web. ARPANET, it wasn't all of that, or the bulletin board services, or the email, and so on. No, there was the arrival of color, and then very quickly sound. Changed everything. That was a crack in the universe. 7 mirrors went up around the world, and suddenly it was democratized, commoditized, the thing took off. And no, that was not going back in the box. The question is, of course, will the next Silicon Valley happen in Silicon Valley? Will it happen in the United States at all? 2023. Oh, I'm sorry, 2022. I'm getting old while I sit here, I think. No, wait a minute. When did AI crash onto the world? Somebody 22 or 23? April of 22. Like I said, I'm getting old while I sit here. Right, sorry, 2025. How the hell did that happen? Okay, in the April of 2022, the second crack in our own lifetime. Right? I mean, most of you don't remember a world without the web, but you were alive during a world without the web. Right? So this was the second one. And again, it existed for 50, 60, 70 years before, maybe more. Right? They even had discussions at the government level for 2 years and more. Do we let it out? Because it will change everything, and so it does. Now, venture equity investing funds, venture capital funds, right, are designed to invest in those root technologies. It's why you do and you should hear in Silicon Valley again and again and again. AI, IoT, blockchain, AR, VR, battery technologies, on and on and on, until you're just so tired of it. And you will hear it again and again, until the next big thing comes along, and then you'll hear that. That's what it's designed to invest in. It is not designed to capitalize the companies that leverage those softwares to build the next decent thing. And yet, that's what it's called. So, better ways to live and work together, better ways to invest. Make sure that it is mutually beneficial for your investor, especially at the early stage. Make sure you have a choice by the time you get to just about that Series A, when you should be showing that the company is selling like crazy. If it's B2C, you've got millions. If it's B2B, you've got, new markets opening up, new territories, whatever it is. You've got a juggernaut of a marketing plan and a process, and it can be executed. And here it is, just pour water on the fire, it will go. Right? They invest for scale. Make sure that you've arrived there. The days when you sit around and create a name, I don't know, we'll call it Google. Right? Yahoo. Right? Those days are over. Don't play a game that was 1997, because it is 2025. So if you're going out for venture equity, make sure you've achieved the criteria required to get there. And that is to demonstrate that the company can scale, and pouring water will make it 10x. Hand you a buck, you better hand me 10x more in value of that company, and do so fairly quickly. Prove that it can be done. Now, proving that it can be done in a pitch deck, right? How to pitch. So, if this is what you're building, and you're going to walk into a VC and say so, it's about the financial projections. And yes, I know, we get the numbers out of blue clean sky and we don't even bump into a cloud. But truly, there is some rationale to have.
You know, we've heard a lot from founders and from various different entities today about how much it sucks trying to start a company. And I'm just really curious, from your perspective, why would you still want to do it?
It's worth it. It's completely worthwhile. I'm not just talking about the cash. Really not talking about the cash. If you have come up with something that is going to create a better way to live or work together on this planet, it's incumbent upon you to build it. Okay? I remember telling this to my oldest son. Well, I'm not sure, do I need it? Okay, gotcha. I remember telling my eldest son when he was in high school, I was taking him over to the local college for some courses and so on, and he was fussing about it. Oh, Ramon doesn't have to do this, and John doesn't have to do this. I said, I know. But it turns out you've got a brain. You didn't ask for it, I didn't ask for it, but you've got it. And so you will not be a ditch digger. I don't know what you're going to be in life, but it turns out that the world actually is communist, not socialist, not anything else. Not necessarily in finance, but to each according to their ability and to each according to their need. You've got an extraordinary ability, so you're going to use it. It's your obligation to leave the world a better place than you found it. Some years later, that same high schooler, now much older, was part of my company, and then we created the company together and so on. And he wrote on the first website a bio, and he was a very young guy. He was still in college, so he didn't have much to say. But he did say that he took this opportunity as an obligation. One kid down, two to go, right? I tell you the same thing. You have an opportunity, it's your obligation to do it. And if it's a crappy idea, go find a good one. If you're an executor to brilliant wizards, find your wizard. Executors are actually the scarcest commodity in the startup world, right? They tend to go into finance. They become bankers, they become accountants, they become, CFOs of existing corporations. They have a low risk tolerance. You find yourself an executor who has a high risk tolerance, boy, that's your person, right? What I'm saying is, it's worthwhile because what you envisioned that would be better whenever you built whatever you built actually comes to fruition. We got to do that. We got to build a company that had a corporate culture that was a whole lot better than the existing corporate cultures, by and large, throughout the United States at the time. Now, a lot of companies are like that. And that's a good thing, too. To be part of that, it's worthwhile, folks. Trust me, it's worthwhile.
Anybody else?
So now I'm going to give you another one. Your students are down in Silicon Valley. They're visiting Seattle for this week. I'm curious from your perspective, can you talk about the differences in our ecosystem versus the Valley?
I can tell you a little bit about it. I'm actually stationed right here in Seattle, Washington. This is our hometown for Mastersfund, and I have not lived in the Valley. We have only one investment that is domiciled down there. I think that there is a massive difference. There's a tremendous amount of capital down there. Seattle is a small market. There is relatively little venture capital here. We have really one venture capital firm that is extremely well established, if you will, Madrona Capital. Everybody else is pretty much an emerging manager. Some have been around longer, but pretty much that's the deal. If you're looking for massive capital, you are going to head to Silicon Valley. If you're looking for health, you can go into Boston. If you're looking for a health product, you can go into Dallas. In other words, when you're looking for conventional venture equity or for alternative forms of venture equity, don't just look in your hometown, right? Do the research. This is not a pray and spray thing. You do research that says, okay, who was it that funded, or which company funded the company that I'm about to replace? In other words, somebody built version 1, I'm building version 2 or 3 or 4 of, right? They invested there. Did they make money on it? They had good exit? That's my venture capital firm. 1, they know what you're talking about. 2, they've already made money in this field. And 3, they'll know whether or not what you're building is going to replace that one. And something always does. The bigger they are, the harder they fall, and so on, right? Somebody always does. That's your firm. Now, find the venture partner in that firm that led the deal. That's your guy. He knows what you're talking about. He's already made money in it. He's going to do it again. Okay? Get good at this. It's a lot of tedious work. But this isn't just about asking anybody for money. Ask the right people for money. Now, if you're a woman in business, or if you're a guy who does not fit the mold, all white Americans, right? The women out there who are venture capitalists, they are 3 times more likely to invest in any diversity on the founding team, not just gender diversity. 3 times, 300% more likely to do so. So you might want to go for that. Sadly, only about 4% of the women in venture capital are in a decision-making role. Okay. One of the things that you might want to think about is you do want to reach a venture partner or a general partner. Right? Reaching the analyst, well, it's their job to kind of bounce around and ask questions, and that's fine. But actually, more often, they're asking you the question because they actually want to invest in that person, and they're just checking to see what this one's like because they might know something that will help with the due diligence of that one. Be careful. Not always, but. So the world continues to change. There was a movie with Danny DeVito called Other People's Money. Has anybody seen this movie? Rather old movie. Maybe stop by and take a short break. You can kind of scooch through it. But there's a very famous line. He said, buggy whips. I'll bet the last buggy whip company was the best buggy whip company in the world. But you would not have wanted to have been a stuffer. He was right. The world changes all the time. AI is massively changing the world. Right? Our ability to send an email has massively changed our requirement for pen, paper, envelopes, and stamps. And for the guy on the horse, the Pony Express, which then became a truck, which then became, you get it? The world evolves. There will be loss of jobs, but most of the jobs that are going to go away because of AI were the kind of jobs you actually don't want a human brain doing. Human brains were designed for something greater. Along the way, in the second half of the 20th century, we lost things here in the United States around music, art history even, things like that. And sometimes even things like recess for little kids. We ended up with an unhealthy population that couldn't do math very well, doesn't know its history, so it's forced to repeat itself and all kinds of other problems. As a result, right, we do have that opportunity to have more of those people around, right, to be more creative, not just to create companies and ideas and software, but also to create things that will beautify our world. We don't know what that future looks like yet. There's always up, there's always down. I think it is incumbent on both our governments and our society at large to make sure that all people get a chance to engage in that future. Right? And as you see in the United States, we didn't. The central swath of the United States was not engaged in the future of technology. As a result, we see the ramifications across society, government, and elections. So those are important elements. And losing jobs is a really good reason for people to get very upset. Make sure that they have an opportunity to, if you will, not easily, because it isn't always so easy, but that they have an opportunity, a realistic one, to engage in the future so they have a hope for a better life for themselves and a better life for their children. And that's in any country, anywhere in the world.
I'll take one more.
We were impressed sharing today. My name is Lin. I want to know when you decided you want to invest in this startup, will you want to invest in the stock not profitable yet? Because we know many many startups struggle in financial crisis, they need money very much. But somehow many receive those but
Right, you're saying the VCs don't want to invest in a non-profit,
not profitable.
in a not yet profitable company?
Yeah. As some companies started to make money, they will think I can make money.
Okay, no. Profitable and revenue positive are two different things.
Because they think we already made money. So
Yeah, but again, revenue positive is different than profit.
they already started to make revenue.
Right, so starting to make revenue is revenue positive. They will want to see that product in the market and somebody wants to buy it, that product market price fit. They will also want to see that you're able to make more and more sales. If they put in the money, you will spend it on sales and marketing essentially, right? Yes, you can spend it on iteration of new products and so on, and sometimes VCs will come in extremely early for those world-changing softwares, right? So in other words, it's just an idea. They say, oh, you're right, that will change everything, and we know how to build that, right? And then they will help those founders to make the whole company. But in general, most people are going to walk into a VC with a product in hand, somebody's bought it in the market, and now they have to really prove that they can sell a whole lot more if a small amount of capital goes in here, relative. Okay, even if it's a 10 million or 100 million that's going in here, relative to what's coming out is relatively small. So it is not that VCs don't invest in companies that are making money. That is what they're looking for. They're looking for you to achieve that in general, not 100%, but in general. And they are looking to see that if they put in money, you will make a whole lot more sense.
I'm not sure about it.
That's the difference in the way people pitch, right? So in terms of pitching, one is often told, speak it as if it were so, not as if you're going to build it. But I would say rather, show your slide, right? This is the entire world that I'm going to build, right? And you could say it as if it's so. The world is using this and that, and this is, the massive amount of profit made and so on and so forth. We are here. And with this amount of money, we'll get to there in 12 months. And then this amount of money we'll get here in 24 months. And then it will take here, and within 5 years we'll be here, right? It's okay to first flesh out and lay out the entire picture. It's world changing. We're going to do this. Today we are here. There is a balance of that honesty of what it is that you're sharing. Does that make more sense? You're not lying to them. I do not espouse that. I think the whole idea that anybody, an angel investor or a VC, would invest into an entrepreneur who's lying to them because we taught them to lie to us is insane. So don't do that, right? But do show the entire vision and then tell them this is where we are and this is where we're going. And then you have to show them how it gets there, how much money and how much time.
The world has changed so fast.
Yes, it does. I think that is the risk. I don't think so. I know it. That is the risk that the VCs take. And they're going to take a look at this and say, is this company building something so that it meets where the ball is going to bounce, not where it is today? And that's the job of the VC. It is the risk.
All right, give it up for Julian, please.